Here are 100 facts about inflation. 1. Inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. 2. It is measured by various price indices such as the Consumer Price Index, CPI, and the Producer Price Index, PPI. 3. The opposite of inflation is deflation, which is a sustained decrease in the general price level of goods and services. 4. Inflation erodes the purchasing power of money, meaning that the same amount of money buys fewer goods and services over time. 5. Hyperinflation is an extremely high and typically accelerating inflation rate. 6. Hyperinflation can have devastating effects on an economy, leading to a loss of confidence in the currency, skyrocketing prices, and economic instability. 7. The quantity theory of money states that inflation is caused by an increase in the money supply relative to the supply of goods and services. 8. Demand pull inflation occurs when aggregate demand for goods and services exceeds aggregate supply, leading to upward pressure on prices. 9. Cost push inflation occurs when the cost of production increases, leading producers to pass on higher costs to consumers in the form of higher prices. 10. Built-in inflation occurs when workers and businesses expect prices to rise in the future and negotiate higher wages and prices accordingly. 11. Inflation expectations can influence actual inflation through their effect on wage and price-setting behavior. 12. Core inflation measures exclude volatile components such as food and energy prices to provide a more stable measure of underlying inflation trends. 13. Asset price inflation refers to an increase in the prices of financial assets such as stocks, bonds, and real estate. 14. Central banks use monetary policy tools such as interest rates and open market operations to control inflation and maintain price stability. 15. Inflation targeting is a monetary policy framework where central banks set explicit targets for inflation and adjust policy instruments to achieve those targets. 16. Central banks often have a target inflation rate, such as 2% per year, to provide a stable anchor for inflation expectations. 17. The Phillips curve suggests a trade-off between inflation and unemployment, implying that policymakers can target either low inflation or low unemployment, but not both simultaneously. 18. The long-run Phillips curve is typically thought to be vertical, indicating that there is no long-run trade-off between inflation and unemployment. 19. Stagflation is a situation where an economy experiences high inflation and high unemployment simultaneously. 20. The misery index is a simple measure of economic well-being that adds the inflation rate to the unemployment rate. 21. Inflation-indexed bonds, also known as inflation-linked bonds or TIPS, Treasury inflation-protected securities, provide investors with protection against inflation by adjusting their principal and interest payments for changes in the CPI. 22. Inflation can have redistributive effects by transferring purchasing power from savers to borrowers and from fixed-income earners to asset holders. 23. Inflation can also reduce the real value of government debt, providing a form of fiscal relief to governments with high levels of debt. 24. Wage price spirals occur when workers demand higher wages to keep up with rising prices, leading to further increases in prices and wages in a self-reinforcing cycle. 25. The term stagflation was coined in the 1970s to describe the combination of stagnant economic growth and high inflation experienced by many countries during that decade. 26. The Great Inflation of the 1970s was a period of high inflation in the United States and other developed countries, driven by factors such as rising oil prices, expansionary fiscal policy, and loose monetary policy. 27. The Volcker disinflation refers to the efforts of Federal Reserve Chairman Paul Volcker to bring down inflation in the United States in the early 1980s by tightening monetary policy and raising interest rates. 28. Inflation can be measured using different indices, such as the GDP deflator, which measures the price level of all domestically produced final goods and services in an economy. 29. The inflation rate can vary widely across different countries and regions, depending on factors such as economic growth, monetary policy, exchange rates, and supply shocks. 30. Inflation can be both anticipated and unanticipated. Anticipated inflation is incorporated into expectations and contracts, while unanticipated inflation can lead to redistributive effects and economic distortions. 31. Inflation can distort relative prices and resource allocation, leading to inefficiencies in the economy. 32. The costs of inflation include menu costs, the costs of changing prices, shoe leather costs, the costs of holding lower money balances due to inflation, and the costs of inflation uncertainty. 33. The winners from inflation include debtors, who repay their debts in cheaper dollars, and asset holders, who see the nominal value of their assets rise, while the losers include creditors, who receive repayment in less valuable dollars, and fixed income earners, who see their purchasing power eroded. 34. The term inflation tax refers to the erosion of purchasing power caused by inflation, which effectively reduces the real value of money held in cash or low interest-bearing assets. 35. Inflation can be particularly harmful to retirees and others on fixed incomes who rely on savings and pensions for their livelihood. 36. Inflation can also have distributional effects within the economy, disproportionately affecting certain groups such as the poor and vulnerable. 37. Inflation can be imported through trade, as changes in the prices of imported goods and services can affect domestic inflation rates. 38. Cost of living adjustments, COLAs, are wage and benefit increases tied to changes in the cost of living, typically measured by the CPI. 39. The term inflationary gap refers to the situation where aggregate demand exceeds aggregate supply at full employment, leading to upward pressure on prices and inflation. 40. The term disinflation refers to a decrease in the rate of inflation, rather than a decrease in the level of prices. 41. Deflation, or negative inflation, is a sustained decrease in the general price level of goods and services in an economy. 42. Deflation can be caused by factors such as weak demand, excess capacity, falling asset prices, or contractionary monetary policy. 43. Deflation can be particularly harmful to an economy because it can lead to falling wages, rising unemployment, and increased real debt burdens. 44. The term stagflation refers to a combination of stagnant economic growth and high inflation, often associated with supply shocks such as increases in oil prices. 45. The term demand pull inflation refers to inflation caused by excess demand for goods and services relative to aggregate supply. 46. The term cost push inflation refers to inflation caused by increases in the cost of production, such as rising wages or raw material prices. 47. The term asset price inflation refers to inflation in the prices of financial assets such as stocks, bonds, and real estate. 48. The term wage price spiral refers to a self-reinforcing cycle of rising wages and prices, where higher wages lead to higher prices, which in turn lead to higher wages. 49. The term inflation targeting refers to a monetary policy framework where central banks set explicit targets for inflation and adjust policy instruments to achieve those targets. 50. The term inflation expectations refers to the public's expectations about future inflation rates, which can influence actual inflation through their effect on wage and price setting behavior. 51. The term core inflation refers to a measure of inflation that excludes volatile components such as food and energy prices, providing a more stable measure of underlying inflation trends. 52. The term inflation premium refers to the additional return investors require on nominal bonds to compensate them for expected inflation. 53. The term inflationary expectations refers to expectations about future inflation rates, which can influence current inflation through their effect on wage and price setting behavior. 54. The term inflationary pressures refers to factors that contribute to upward pressure on prices, such as excess demand or rising production costs. 55. The term inflation adjusted refers to values that have been adjusted for inflation, allowing for comparisons of purchasing power over time. 56. The term inflationary gap refers to the difference between actual output and potential output at full employment, which can lead to upward pressure on prices and inflation. 57. The term inflation hedge refers to an asset that tends to maintain its value or appreciate in real terms during periods of inflation. 58. The term inflation forecast refers to an estimate of future inflation rates based on current economic conditions and trends. 59. The term inflation shock refers to a sudden and unexpected increase in inflation rates, often resulting from supply disruptions or changes in monetary policy. 60. The term inflation target refers to the rate of inflation that a central bank aims to achieve over a specified time horizon, typically set by government mandate or agreement. 61. The term inflation rate refers to the percentage change in the general price level of goods and services over a specified period, typically measured on an annual basis. 62. The term inflation rate differential refers to the difference in inflation rates between two countries, which can affect exchange rates and trade flows. 63. The term inflation-adjusted return refers to the return on an investment after accounting for the effects of inflation, providing a measure of the investment's real purchasing power. 64. The term inflation inertia refers to the tendency of inflation rates to remain relatively stable over time, even in the face of changes in economic conditions or policy measures. 65. The term inflation persistence refers to the tendency of inflation rates to remain elevated or subdued for an extended period, even after the initial shock that caused them has dissipated. 66. The term inflation scare refers to a sudden and sharp increase in inflation rates, often triggered by fears of rising prices or overheating economies. 67. The term inflation shock refers to a sudden and unexpected increase in inflation rates, often resulting from supply disruptions, changes in monetary policy, or other exogenous factors. 68. The term inflation uncertainty refers to uncertainty about future inflation rates, which can affect economic decision-making and market behavior. 69. The term inflation volatility refers to the variability of inflation rates over time, which can affect economic stability and policy effectiveness. 70. The term inflationary expectations refers to the public's expectations about future inflation rates, which can influence current inflation through their effect on wage and price setting behavior. 71. The term inflationary pressures refers to factors that contribute to upward pressure on prices, such as excess demand or rising production costs. 72. The term inflationary gap refers to the difference between actual output and potential output at full employment, which can lead to upward pressure on prices and inflation. 73. The term inflation adjusted refers to values that have been adjusted for inflation, allowing for comparisons of purchasing power over time. 74. The term inflation hedge refers to an asset that tends to maintain its value or appreciate in real terms during periods of inflation. 75. The term inflation forecast refers to an estimate of future inflation rates based on current economic conditions and trends. 76. The term inflation shock refers to a sudden and unexpected increase in inflation rates, often resulting from supply disruptions or changes in monetary policy. 77. The term inflation target refers to the rate of inflation that a central bank aims to achieve over a specified time horizon, typically set by government mandate or agreement. 78. The term inflation rate refers to the percentage change in the general price level of goods and services over a specified period, typically measured on an annual basis. 79. The term inflation rate differential refers to the difference in inflation rates between two countries, which can affect exchange rates and trade flows. 80. The term inflation-adjusted return refers to the return on an investment after accounting for the effects of inflation, providing a measure of the investment's real purchasing power. 81. The term inflation inertia refers to the tendency of inflation rates to remain relatively stable over time, even in the face of changes in economic conditions or policy measures. 82. The term inflation persistence refers to the tendency of inflation rates to remain elevated or subdued for an extended period, even after the initial shock that caused them has dissipated. 83. The term inflation scare refers to a sudden and sharp increase in inflation rates, often triggered by fears of rising prices or overheating economies. 84. The term inflation shock refers to a sudden and unexpected increase in inflation rates, often resulting from supply disruptions, changes in monetary policy, or other exogenous factors. 85. The term inflation uncertainty refers to uncertainty about future inflation rates, which can affect economic decision-making and market behavior. 86. The term inflation volatility refers to the variability of inflation rates over time, which can affect economic stability and policy effectiveness. 87. The term headline inflation refers to the overall rate of inflation, including all goods and services in the economy, while core inflation excludes volatile components such as food and energy prices. 88. The term high inflation refers to inflation rates that are significantly above the central bank's target or historical average, often leading to economic instability and policy intervention. 89. The term low inflation refers to inflation rates that are below the central bank's target or historical average, which can indicate weak demand or excess capacity in the economy. 90. The term moderate inflation refers to inflation rates that are within a moderate range, typically consistent with central bank targets and conducive to economic growth and stability. 91. The term persistent inflation refers to inflation rates that remain elevated or subdued for an extended period, often requiring sustained policy action to address underlying economic imbalances. 92. The term transitory inflation refers to temporary increases in inflation rates caused by supply disruptions, changes in relative prices, or other transitory factors that are expected to dissipate over time. 93. The term inflation targeting refers to a monetary policy framework where central banks set explicit targets for inflation and adjust policy instruments to achieve those targets, often aiming for low and stable inflation over the medium term. 94. The term price stability refers to a situation where the overall price level of goods and services in an economy remains relatively stable over time, providing a stable anchor for economic decision-making and planning. 95. The term inflation expectations refers to the public's expectations about future inflation rates, which can influence actual inflation through their effect on wage and price-setting behavior. 96. The term inflation premium refers to the additional return investors require on nominal bonds to compensate them for expected inflation, reflecting their expectations of future purchasing power erosion. 97. The term inflationary pressures refers to factors that contribute to upward pressure on prices, such as excess demand or rising production costs, which can lead to inflationary outcomes if left unchecked. 98. The term inflationary gap refers to the difference between actual output and potential output at full employment, indicating the presence of excess demand and the potential for upward pressure on prices and inflation. 99. The term inflation-adjusted refers to values that have been adjusted for inflation, allowing for comparisons of purchasing power over time, often expressed in real terms or constant dollars. 100. The term inflation hedge refers to an asset or investment strategy that tends to maintain its value or appreciate in real terms during periods of inflation, providing protection against the erosion of purchasing power.